Most people think taxes are just what the government takes. But there's a hidden tax stealing 20% of your income right now. And no, I'm not talking about inflation or interest rates. I'm talking about something so embedded in your daily life that you don't even notice it's happening. By the end of this video, you'll see exactly where that 20% is disappearing and how to get it back. Chapter 1. The Setup 1 to 3. Let's start with a concept called lifestyle inflation. You get a raise, you celebrate, you upgrade your apartment, you buy a nicer car, you start eating out more. Sounds normal, right? Except here's what nobody tells you. Every time your income increases, your spending increases faster. And I mean faster. Studies show that for every dollar of increased income, the average person spends $1.20. Yes, you read that right. You're spending 20% more than you're earning. That's the invisible tax. It's not a line item on your paycheck, it's a psychological tax on your ability to build wealth. Let's take a closer look. You got a raise of $5,000. Sounds like good news, right? But what happens next? You upgrade your lifestyle. You take the extra $5,000 and use it on things that make you feel better in the moment, like a vacation, new clothes, or a fancy dinner. So instead of saving or investing that extra income, you end up spending it. And before you know it, you're in the same place as before, only now you're more used to living in a higher cost lifestyle. But here's the kicker. The lifestyle upgrade doesn't just stop there. Your higher income becomes your new baseline. That extra spending, it becomes the new normal. Think about the last time you got a raise. Did you find yourself treating yourself to new gadgets or eating out more often? Did you tell yourself, I deserve this? Well, here's the psychological trap. The more money you make, the more you feel entitled to spend. And before you know it, you're not saving more, you're spending more. Just like that. Psychological trap. Now, why does this happen? Because of something called hedonic adaptation. Your brain is wired to get used to anything. That first month in the nicer apartment feels amazing. By month 6, it's just your apartment. The thrill is gone, but the higher rent, that's forever. And here's where it gets dangerous. You don't even realize you're adapting. You just keep spending to maintain the same level of happiness. It's like running on a treadmill that's gradually speeding up. You're working harder, spending more, but getting nowhere. Let me break that down. Think about when you first moved into your upgraded apartment. The excitement was real, right? You probably thought, this is the life, I made it. But after 6 months, that same apartment doesn't feel special anymore. You start looking at new things to upgrade. Maybe a bigger TV, or new furniture. That initial happiness starts to fade because your brain is already used to it. That's hedonic adaptation at work. Your brain seeks novelty and pleasure, but the excitement wears off faster than you think. And the cycle begins again. The treadmill keeps speeding up. For example, let's say you bought that brand new phone. It felt amazing at first, sleek, fast, and shiny. But after a few weeks, it's just another phone. And now, you're craving the next upgrade. This isn't about a lack of gratitude, it's simply how the brain works. The happiness you get from the upgrade doesn't last long, and soon, you're back to seeking more. The 20% calculation. Let's run the numbers. Say you're earning $60,000 a year. You get a 10% raise to $66,000. That's an extra $6,000. But lifestyle inflation means you'll spend $7,200 more. Where does that extra $1,200 come from? Your savings, or worse, your credit cards. Over 5 years, that 20% tax steals $6,000 from your future. But wait, we're not done. Because that $6,000 could have been invested at 8% returns. That's $8,800 you just lost. The invisible tax isn't just stealing your present income, it's stealing your compound interest. Let's do a quick comparison. Imagine 2 people, person A and person B. Person A. They're earning $60,000 and get a 10% raise. Instead of saving or investing, they decide to upgrade their lifestyle, fancier car, more expensive vacations. Over the next year, they spend $7,200 more. Person B. They get the same raise, but they decide to invest that $6,000 difference. Over the next year, their investments grow at 8%. That $6,000 turns into $6,480, and by year 5, that $6,000 could grow into $8,800. They're on the path to wealth, while person A is stuck in the cycle of lifestyle inflation. Now, let's talk about compound interest. If you were to take that $6,000 and invest it at 8% return, in 5 years it could have turned into $8,800. But because of the invisible tax, you missed out on that. Imagine what that $8,800 could turn into after 10 or 20 years. This is the cost of lifestyle inflation. It's not just about today's extra spending, it's about the wealth you're losing in the future. 3 invisible tax categories. So where exactly is this tax hiding? I've identified 3 main categories. First, subscription creep. You added Netflix, then Hulu, then that fitness app, then the meditation app. That's $50 a month you didn't have last year. Second, convenience upgrades. You used to make coffee at home, now you grab Starbucks because you deserve it. That's $100 a month. Third, social spending. Your friends are going to nicer restaurants, so you join them. Another $150 a month. Total, $300 a month. That's $3,600 a year. That's your invisible tax. Let's dive deeper into each of these categories. Subscription creep can sneak up on you. You might think it's just $5 here, $10 there, but over time it adds up. Have you ever thought about how many subscriptions you have Netflix, Amazon Prime, Spotify, Apple Music, Hulu, Disney Plus, and realized that you're paying for multiple streaming services you barely use? Now let's talk about those little convenience upgrades, the $5 coffee every morning or that impulse buy when you're out shopping. It doesn't seem like much, but when you add it up, it's costing you hundreds of dollars every month. And social spending, this is a big one. Your friends invite you to a fancy dinner, or they want to go to an expensive bar. You think, I deserve to treat myself, but when you track it, you'll see that these little social expenses are draining your budget. The tax refund strategy. Now, how do you get that money back? With what I call the tax refund strategy. Step 1. Track every dollar for 30 days. Not just categories, every single transaction. Step 2. Identify the invisible tax items. Anything that's increased since your last raise. Step 3. Calculate your refund. That $300 a month, that's your refund. Step 4. Automate the transfer. The day after your paycheck hits, move that $300 to a separate investment account. You just turned a tax into a wealth-building machine. Building anti-inflation system. But we can't stop there, because lifestyle inflation will keep trying to creep back in. So you need a system. I call it the anti-inflation system. First, the 24-hour rule. Any non-essential purchase over $100 waits 24 hours. Second, the one in, one out rule. New subscription, cancel an old one. Third, the value audit every 6 months. Review every recurring expense. Ask, does this still bring me joy or value? If not, cut it. This system turns you from a passive victim into an active defender of your wealth. Advanced tactics. For those ready to level up, here are advanced tactics. First, stealth savings. When you get a raise, immediately increase your 401k contribution by half the raise amount. You never see the money, so you can't spend it. Second, expense arbitrage. Find cheaper alternatives that deliver 80% of the value for 50% of the cost. Third, income segregation. Create separate accounts for different income sources. Bonus money goes straight to investments. This creates psychological barriers against spending. Case studies and implementation. Let's look at real examples. Sarah, 28, got a $5,000 raise. She identified $150 in invisible taxes. She automated that to her Roth IRA. In 30 years, that's $150,000 extra retirement. Mike, 35, found $400 in subscription creep. He canceled half, invested the rest. That's $200 a month. $2,400 a year, $200,000 in 20 years. Your implementation starts today. Track your spending. Identify your invisible tax. Automate your refund. The system works, but only if you work the system. If you're realizing how much this invisible tax costs, subscribe for next week's deep dive where we'll break down exactly how to optimize your spending without feeling deprived. That 20% isn't just money. It's your future freedom back under your control. It's the difference between retiring at 65 and retiring at 55. Between worrying about bills and sleeping peacefully, between being a passive participant in your financial life and being the architect of your own wealth, the invisible tax steals from everyone. But from today forward, it won't steal from you.